All right, so you've heard me talk about life insurance and why it's such a great place to build your money tax-free. And basically, you're building a tax-free retirement account, a tax-free bank account. The long and the short of it here is there are three ways to remove money from a life insurance policy. There's what's called the sad way. You die, and I always make a joke. I'll try to make your heirs look sad when I hand them a check for $1 million. And there's the dumb way. We withdraw money. So we go into our policy and we use the word withdrawal, and we would like to withdraw money from our policy. So when we withdraw money from our policy, what that means is that we're actually taking out the money. And if we withdraw above the basis, all money that we withdraw is taxed at ordinary income. Now, the smart way is to always borrow. And so we're always going to use a loan provision when it comes to borrowing from our policy. So the way that this works here is we're going to go out and we're going to build our life insurance policy, remembering that we're going to use TEFRA, DEFRA, TAMRA, 101C, 101A, 7702 of the tax code, and we're going to build it within the limits of the IRS. So we're going to buy the least amount of insurance using the most amount of money. It'll take us typically a minimum of 4 years, possibly 5 years to do that, or even longer, depending upon how we're funding the policy. As we're funding that policy, the cash values increase and the death benefits and access to the capital increases. So this green that we see over here, this is our cash value. And we can go and we can access up to 85% of that at any time without any problem by simply using a loan provision. So when we borrow the money, we're actually not going to borrow this money here. We're going to leave this money here working for us while we borrow the insurance company's money. Now, the insurance company's not going to ask us any questions about why we're borrowing the money. They're simply going to loan it to us. And the reason why they're going to loan it to us is because they have the collateral over here to cover that loan at any point in time. So if I was to die at this point, my heirs will get the death benefit less the loan. If I was to say, give me back all my money, I would get this less the loan. So I'm not required to pay back the loan unless I exit. And I exit either by taking all my money or exit by dying. Now, loan payments are made to the company. They're not made to the policy. Premiums are paid into the policy, but loan payments are paid directly back to the company. And once again, they're not required to be paid back unless I'm exiting. The internal growth adds an additional contribution into the collateral capacity. So if I go back to when I was taking out that loan, not only am I over here growing interest on this, but I'm also growing on my money over here. And typically, I'm going to have a positive arbitrage. Now, with an index product, it is possible that I would have a year where I made zero inside of my product, and I was still paying 5% or whatever the variable rate was on my life insurance policy. So I might not have a positive arbitrage. Often when you're using whole life, the interest rate that you're borrowing at is higher than the interest rate that you're actually making. So we have a negative arbitrage in that case. Doesn't make it bad, it just makes it different. Now, the thing you want to remember about a loan is that you have guaranteed access to the cash value of the policy loan. And typically you want to use a rule, a generalization of about 85% of whatever that cash value is. You don't want to get in a position where your policy is going to lapse. So you want to leave enough money in there that even in the worst years, it will cover itself. You're never asked the purpose of the loan. So you can borrow the money. They're not going to ask you if you're going to buy a car with it or fund your children's college or take care of long-term care. They're not going to look into what that is. Your loan does not show up on any credit reports. So it's not required. It's not reported. Loans are collateralized against your cash value. You have a non-structured payments, meaning that you can pay it back anytime you want or not pay it back at all. Policy loans do not require that you drain your tank. So you keep your money there working for you while you use the insurance company's money. And you can also be continuing to grow your money. Your cash value continues to grow without a loan. Loan payments are made to the insurance company, not to your policy. And in the event of a death, your loan balance is subtracted from the face amount, or in the event that you were to cash out your policy, the loan balance is subtracted from the actual value of the policy. So keep in mind that this is a great aspect to have, because let's just use, for example, let's say we went out and we got a Roth IRA. Now, all the money that we put in the Roth IRA is after-tax money, just like it would be inside of life insurance. But in the Roth IRA, we can take out the principal anytime we want, but we can't put it back any more than whatever our limits are for contributions on the Roth IRA. Whereas with the life insurance, we can take out the principal and the growth anytime we want, and we have a choice as to whether we want to put it back or not. There's a lot of other good reasons why to do this. We have the death benefit on the backside, but at the end of the day, this video was about loan provisions. So please be sure to subscribe to our YouTube channel, follow us on LinkedIn, visit our website at www.yoursafemoneypeople.com. Remember to live like you're going to die tomorrow and plan like you're going to live forever, because you just might. Make it a great day, and we'll talk to you real soon.